Student loans. For millions of people, they're the price of admission to higher education. You need a degree, the degree costs money you don't have, so you borrow it. Simple, right? Except it's not. Student loans are one of the most misunderstood financial products out there, and that confusion costs people hundreds of thousands of dollars over their lifetimes. Today, we're breaking down exactly what student loans are, how they work, and most importantly, how to avoid drowning in debt for decades. That signature commits you to debt that in most cases cannot be discharged in bankruptcy. It follows you for decades. It affects everything from buying a house to starting a family to changing careers. There are two main types of student loans, federal and private. Federal loans come from the government. They have fixed interest rates, flexible repayment options, and built-in protections. Private loans come from banks, credit unions, or online lenders. They usually have higher interest rates, fewer protections, and stricter repayment terms. If you have to borrow, federal loans are almost always the better choice. They're more forgiving, literally and figuratively. Within federal loans, there are two main categories, subsidized and unsubsidized. Subsidized loans are based on financial need. The government pays your interest while you're in school, during your grace period, and during deferment. Unsubsidized loans are available to everyone, regardless of need. But interest starts accruing the moment the loan is disbursed. That interest capitalizes, meaning it gets added to your principal balance, and then you're paying interest on interest. A $10,000 unsubsidized loan can balloon to $15,000 or more before you even make your first payment. If you borrow $50,000 at 6% interest and take 20 years to pay it back, you'll end up paying over $72,000 total. That's $22,000 just in interest. You're essentially paying for your education twice. Let's talk interest rates. Federal loans for undergraduates currently sit around 5 to 6%. Graduate loans are higher, around 7 to 8%. Private loans can range anywhere from 4% if you have excellent credit to 14% if you don't. And here's what most people don't realize: interest compounds. If you borrow $50,000 at 6% interest and take 20 years to pay it back, you'll end up paying over $72,000 total. That's $22,000 just in interest. You're essentially paying for your education twice. When it's time to repay, you've got options, but they all have trade-offs. The standard repayment plan gives you 10 years to pay off your loans with fixed monthly payments. You'll pay the least interest this way, but your monthly bill will be high. Extended repayment stretches it to 25 years, lowering your monthly payment but costing you way more in interest over time. Graduated repayment starts with low payments that increase every 2 years, assuming your income will grow. Spoiler, it doesn't always. Income-driven repayment plans are a lifeline for borrowers who are struggling. These plans cap your monthly payment at a percentage of your discretionary income, usually 10 to 20%. If your income is low, your payment could be as little as $0. After 20 to 25 years of qualifying payments, any remaining balance is forgiven. Sounds great, right? Here's the catch. Forgiven loan amounts are treated as taxable income. If $50,000 is forgiven, the IRS considers that $50,000 of income, and you could owe taxes on it. That's called a tax bomb, and it's a nasty surprise. Public Service Loan Forgiveness is a program for people working in government or nonprofit jobs. Make 120 qualifying payments, about 10 years, and your remaining balance is forgiven. And unlike IDR forgiveness, this forgiveness is tax-free. The problem? The program is notoriously difficult to navigate. The rejection rate has been over 90% because of confusing rules and paperwork errors. But if you qualify and do it right, it can save you tens of thousands of dollars. Deferment and forbearance are temporary pauses on your loan payments. Deferment is better because subsidized loan interest doesn't accrue. Forbearance allows you to stop or reduce payments temporarily, but interest keeps piling up on all loans. Use them sparingly and strategically. These options can give you breathing room during unemployment or financial hardship, but they're not free. Every month you're not paying is a month interest is growing. Defaulting on student loans is financial suicide. You're in default if you're 270 days late on federal loans or 90 days on private loans. The consequences? Your credit score tanks, making it nearly impossible to get a mortgage, car loan, or even rent an apartment. The government can garnish your wages without a court order, taking up to 15% of your paycheck. They can seize your tax refunds, and unlike other debts, student loans don't go away. They follow you forever. So how do you avoid borrowing too much? First, calculate the total cost of your education, not just 1 year. If tuition is $30,000 per year, that's $120,000 for 4 years. Then, multiply your expected starting salary by 1. That's the maximum you should borrow. If you'll make $50,000 per year after graduation, borrowing more than $50,000 puts you at risk. It's a guideline, not a guarantee, but it's a reality check most students don't do. Scholarships and grants are free money. Apply for everything, even small awards. A $500 scholarship here, a $1,000 grant there, it adds up. Unlike loans, you never have to pay this money back. Work-study programs let you earn money while in school through part-time campus jobs. The income doesn't count against you on the FAFSA. It's not glamorous, but working 10 hours a week in the library can reduce how much you need to borrow. Every dollar you earn is a dollar you don't have to pay back with interest. Community college for the first 2 years is one of the smartest financial moves you can make. Tuition is a fraction of 4-year universities. Spend $5,000 per year at community college instead of $30,000 at a university, and you've saved $50,000 before you even get to your major. The diploma doesn't say you started at community college. Refinancing student loans can save you money if you have good credit and stable income. You're taking out a new private loan at a lower interest rate to pay off your existing loans. You could lower your rate from 7% to 4% and save thousands. But here's the trade-off. When you refinance federal loans, they become private loans. You lose all federal protections, income-driven repayment options, and loan forgiveness eligibility. Only refinance if you're certain you won't need those protections. Parent Plus loans let parents borrow to cover their child's education. These are federal loans, but they're in the parent's name, not the student's. Interest rates are higher, around 8%. Repayment starts immediately. Parents, if you're considering this, understand your child is not responsible for these loans. You are. If something happens to them, if they drop out, if they can't find a job, you're still on the hook. Don't sacrifice your retirement to fund your child's education. Co-signing a private student loan makes you equally responsible for the debt. If your child misses a payment, it hits your credit score. If they default, the lender will come after you. Many parents think they're just helping their kid qualify, but you're not a reference, you're a co-borrower, and it's nearly impossible to remove yourself later. Let's talk return on investment. Not all degrees are created equal financially. A $200,000 debt load makes sense for a doctor or lawyer with high earning potential. It makes no sense for a job that pays $35,000 per year. I'm not saying don't pursue your passion, but be realistic about how much debt you can handle. Check average salaries for your intended career. Look at job placement rates for your school and program. Education is an investment, and like any investment, consider the return. There are alternatives to traditional 4-year degrees that don't require massive loans. Trade schools for electricians, plumbers, dental hygienists can lead to well-paying careers with far less debt. Apprenticeships pay you while you learn. Coding boot camps and certificate programs can launch tech careers without a bachelor's degree. The path to a good career doesn't always require $100,000 in loans. If you already have loans, here's how to take control. First, know what you owe. Log into the National Student Loan Data System for federal loans and check all your servicers. Make a list: loan type, balance, interest rate, servicer. Next, if you have multiple loans, focus on the highest interest rate first while making minimum payments on others. This is called the avalanche method, and it saves you the most money. Or use the snowball method. Pay off the smallest balance first for psychological wins. Pay more than the minimum if you can. Even an extra $50 a month can shave years off your repayment and save thousands in interest. Specify that extra payments should go towards principal, not future payments. Some servicers will automatically apply extra money to next month's bill, which doesn't help you. Set up auto payments. Most servicers give you a 0.25% interest rate reduction if you enroll in auto pay. It's not huge, but it's free money. If you're struggling, reach out to your loan servicer immediately. Don't ignore the problem. They can help you switch repayment plans, apply for deferment, or explore other options. Ignoring your loans leads to default, and default is far worse than any short-term solution. Student loans are not inherently evil. They give millions of people access to education and opportunities they wouldn't have otherwise. But they're powerful financial tools that demand respect and understanding. The problem isn't the loans themselves, it's the lack of education about them. Nobody teaches you this in high school. Nobody sits you down and explains compound interest, repayment plans, or the consequences of default when you're 17 and signing your life away. Because the best time to understand student loans is before you sign. The second best time is right now. Take control. See you next time.